Okay, welcome guys to this second segment of part one of module 6 on QTech's price ladder setups. Now, we're still building a bit of a framework before we actually look on to what fading is and how to approach it on the price ladder. Fading, obviously, just a contrarian approach to the market. And I just want to build a bit of a simple model of the market so that you guys can understand the framework within which I work on a daily basis, weekly basis when I'm building my plans and seeing where the market is valuing things and trading accordingly. So what we go through is auction theory, a bit of auction market theory, volume profiling, and we'll show a little bit of an analogy along with that. So basically what we're trying to do here, this part, is want to build a simple model of the market. To some sort of framework or structure that we can understand the market and how it does business. Because at the end of the day, the market is somewhere where traders, people in the market, are facilitating trade. So the first and foremost thing that we want to look at is, like I just mentioned, auction market theory. Now, I can't possibly go through all of this in very much depth. For those of you that have read through this before and have done market profile, that's great. So you'll understand this very, very quickly. You've probably already done this before. For those of you who haven't done auction market theory or market profile, I'd highly suggest you do it. I'm not going to cover it in this course because it's not part of the scope of the course, and I'm doing a very quick refresher just so that when I'm talking about these things, you can understand what I'm talking about on the price ladder. And it's important to understand this because when you finally see the price action, you'll see what I mean when I say there's good auctioning off of these prices, there's good auctioning off of these levels. So let's just take a look. What is auction market theory? So the first and foremost thing that we have to understand is that the market is there to facilitate trade. And it's basically there so that buyers and sellers can come together and do their business. In the process of doing their business, all the market is trying to do by trading with one another at different prices, is trying to find value. So we have to understand, another thing you have to understand auction market theory is that the market is constantly seeking value. So when I say value, I mean like we've drawn before in a distribution. So if we were to draw a small little distribution for you guys here, something like this. Basically, in this case scenario, the majority of what's traded in here, or as we would say, the value area, is about 70%. 70% of the volume. We're going to look specifically at volume, not time, because that's specifically to market profile. 70% is traded in this region. Everything else at that is considered outside of value. So the market's constantly trying to find where it values something, values a security, values a product, values whatever it's trading. And in this case, we're trading futures. So where does it value this particular future? That's what the market's doing. It's trying to find value, and the market is just constantly moving from value area to value area, seeking new value. So that is the premise of the market, and it's there to facilitate trade, like we said. And in doing so, each price that you see on the ladder, each price you see in a chart, is constantly being advertised. So we have to understand the concept that prices are being advertised to both buyers and sellers. So that the important thing here is to understand that at each price, no matter what the price is, if you were looking at a ladder, at each price up and down the ladder, when that price becomes available to both buyers and sellers, um, the sellers can react to that price just as much as the buyers can react to that price. If the buyers react more, let's say, more aggressively and quicker than the sellers, then it shows that there's more value for the buyers there. And conversely, for the sellers, if we get, if we get to this area, um, if we're trading within this area, and you could see the majority of the trade takes place in here. If we get outside of it and get into this area, the sellers are going to be very willing to take the short trade here more than the buyers. The buyers will see less value in here because the value area is within this area here. The value area is in this area here, like we just mentioned. So anything above here, the sellers will find value in. And anything below here, the buyers will find value in. So we'll constantly be doing this process where at each price, when we get down to these areas, at this price, that price is now advertised to both the buyers and sellers. Do the buyers want to take it or do the sellers want to take it? If actually we get below this area and at this price, when it's advertised to the sellers still want to sell lower, well, then maybe we're seeking new value to the downside. So that's how you have to kind of interpret how the market trades with one another. Prices are being advertised, the market's facilitating trade, and it's always trying to seek value or seek where value is located. So if you understand that concept, it's a very powerful concept just to get your head around. You can start understanding how the market actually auctions off prices. If I give you just a very, very simple example, just something to memorize, let's just say, we were auctioning a private jet. And we all know, let's just say for the sake of argument, we all knew that that private jet more or less was valued at about 1 million in the market. And let's just say we start the bidding of the auction. Start the bidding at 1,000 pounds. Now, what do you guys think is going to happen if I start the bidding at 1,000 pounds? Well, the buyers are going to see that value and they're going to step in very aggressively. So if I'm selling this private jet for 1,000 pounds, let's just say I have an endless supply of private jets, just a lot of private jets, very big supply, and I'm selling them for 1,000 pounds starting bid. And I see that there's a lot of buyers that come into the market. I'm inundated with buyers at 1,000 pounds. I start saying, okay, well, I can sell this a little bit higher. So I start selling it at 2,000 and then 3,000 and then 5,000. It just moves up higher and higher, 10, 20, 30, 40, 50, 60, and it'll keep moving up higher, 100 grand, 200 grand, 300 grand, and it'll keep moving so long as I'm inundated with buying. The more, as I keep getting buying, I'll keep lifting my price because I know I can get a higher price. At some point, though, when they realize, when some of these buyers, for example, realize, oh, well, this guy's started the auction at 1,000, I can still get a bargain for this. It gets up to, let's say, 750, 800,000. And we're not too far off the value of the actual private jet, but they realize this guy started selling it for, I'm gonna actually put my bids in a little lower because now I'm paying up very close to the value of it. And maybe I can't sell it into the marketplace that easily. So I'll put my bid in at, let's say, 600,000. And the last traded transaction was at 750, and now I'm not really getting many buyers. So at this point, I say, I still have quite a few jets. Maybe I should just put my price down. I'll accept it. I'll hit the bid down at 600 grand. And if more buyers realize, wait, we can still get even a better bargain because he's just come down to 600 grand. Maybe another guy comes down to 500 and I hit him at 500. Now we're starting to auction a little bit lower. So in that process, we started the bidding. So if we just drew something here, if we started the bidding at 1K, we basically shot up really, really quickly to about, let's say, 750K. And then we slowly started trickling down because I realized I needed to I needed to sell them. And then eventually we hit a floor where there's a lot of demand, let's say at 300K. A lot of buyers step in. So I start saying, okay, maybe I can sell this a little higher now. And then it auctions higher. Now imagine what would have happened. For example, the lower and lower I set this price, this tail would have exploded even faster. If I set this at 100 pounds, or let's just say I set it at 1 pound. If I set the price of the jet at 1 pound, so I put 1 pound GBP, you can buy a jet. The price of that jet, I mean, the way in which this would auction would be astronomical. At 1,000 pounds, it was 1%. We're talking 0.01%. So, even less, 0.0001%. So we're looking at something that's just gonna fly. Everyone's gonna want to buy a jet at 1 pound. So I'm just trying to try and mentally envision an auction like that. And then you could start understanding when a market gets to a really good level or a really good area where buyers find value, just envision what the price action should look like. And I'll show you when we get to the next part what that looks like, but try and envision it in your head. Now, I'll just try and erase this first. I just want to go through one last concept before we actually move into fading. So, as we just discussed this concept of auctioning and the market seeking value, going from value area to value area, I want to go through something called volume profiling. So if I had to draw an example, so let's just say something like this. Something like this, where the market kind of value, 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 value. Okay, let's just look at this example. So the market's continuously looking for value. Now, as we said before, we have this little area in here is the value areas. Let's say these are each day or months, or this could be anything. We could be looking at this volume profile, like we just said, this is volume profile. We could be looking at this volume profile over it could be one day. This could be just, over various prices in one day. This could be a month, over months, over weeks, whatever it may be. There's always going to be a volume profile around it. This is where the majority of the value is. So you've got value area. Sorry. So we've got value area, value area, and value area. And at these levels, what you'll find is somewhere in this value area we'll have what's called a VPOC. And we call it a VPOC. For those of you that have done market profile theory, you understand what a VPOC is, the volume point of control. But let's just call it a high volume node. So these are high volume nodes. These are areas where the market did a lot of business. The market did loads of business at these prices. So at the highest peak of each one is where we have a high volume node. And that is basically the most accepted price on the day, the week, the month, whatever time frame we're looking at. So that is a very accepted price where market participants did a lot of business. They traded a lot of contracts, the most contracts, in fact, within that value area. So you have to understand what these high volume nodes are. Is usually in the middle of a range where the market's accepted value. And then the end bits that we see in here, these end bits in here, right in here, these are tails and areas where there's low volume. So what would you think these are called right here? This, and this. Well, this is called a low volume node. And these levels are areas where the market did very little volume. In fact, these are most probably the good levels. And this is why I'm going through this now, because the next part we're going to look at fading and contrarian type trade opportunities where we're going against the market's move. So the market's moving one way, and we want to go against it. We want to find areas where we can fade. And these LVNs are usually good areas. So that's one thing to keep in mind. So we understand that the market's moving from value area to value area, seeking new value in the areas where we have high volume, a lot of business taking place, in areas where there's been low volume, very little business has taken place. Now, if we put this into context, and I'm going to try and draw this out for you guys. If we drew, now if you guys remember what I drew for you guys in, if I'm not mistaken, I think it was the front running part of the course. I basically drew you guys a room. And in that room, I put a ceiling and I put a floor in. Now, let's expand on that theory where we've got a room and actually look at it in terms of a building. So now we're looking at it in terms of a building. So if we extend these, actually, you know what? I'll just draw this here. We extend that over to this other side here. Extend that over to the side in here. And then one last one in here. So what you'll realize in these kind of scenarios, so if this was basically, we have a ceiling here, well, relative, if you're in this zone, this is your ceiling, this is your floor. And then if you're in this area, this is your ceiling, this is your floor. Ceiling, floor, ceiling, floor. And this is not a specific theory, it's not something I've, come up with or anything. I remember seeing this somewhere. I can't remember exactly. Maybe it might have been jigsaw trading, or a long time ago when I was on the grad scheme, I saw something to do with a building. And it's a good way to just envision how the market moves from one level to another. So if we just kind of use that now and say, okay, well, I know that this is the areas that we have high volume and low volume, high volume. If I can just draw, let's say, a simple line chart of the market moving, it would look something like this. Like if it were to move within these regions, it would something like this. Resistance. And notice how it's spending a lot of time in here. Then it breaks it, holds it, moves higher, use this as resistance, maybe trades in here for a while, then breaks it, uses that, trades that, maybe false breaks that, comes back above. Overall, very, very bullish market. But I think you get the gist of what I'm saying here. If you can now realize, very simply, the majority of trade takes place in here, in here, in here, and in here. And everything that we see in these regions, right in here, very little traded. So that's what I mean. In these regions, again, in here, kind of went through very quickly, use this as resistance, then support, and then again here. So notice in these areas, we're doing very little trading, and thus we have very little volume done there. Every single one of these areas. So now I hope you guys can get a clearer picture of what this looks like and why the market moves. Now, obviously, once these high volume nodes are created, and this is a little bit more advanced, and I don't want to delve into that too much, just understand this concept alone. At some point, obviously, once these high volume nodes are created, eventually they get used as support and resistance as well. So don't get me wrong, high volume nodes are also used as support and resistance once they're made. and accepted by the market. And eventually, even these areas, these low volume nodes, are auctioned off because the market tends to try and auction every area. Just because it used it as previous support and resist doesn't mean it won't try and go back and fill it in. It wants to discover whether there's value there or not. And eventually, in most cases, from what I've seen in my trading career, it does actually fill a lot of these areas in. So anything that's not traded in too much, it tends to go back and try and fill it in and auction it off. But just as a very simple structure, you understand now how the market moves, tries to find value, as we said. So it'll find value in here, then it breaks out, finds value in here, breaks out, and if we just had to label them, we have got value area 1, value area 2, value area 3, value area 4. And obviously, this is a very rough drawing, but you get the picture. These are all your value areas, and in between, you've got your low volume nodes where you have good support and good resistance. I think you can kind of grasp where I'm going with this and how we can use this to find good levels to fade or trade against. And when I mean fade, I mean if the market's moving, if the market's very clearly moving in an uptrend here, you're looking to potentially sell here for the move back down. So that's what I mean by fading. And we'll go through that in the next video. Thanks very much for listening.